Hey, welcome to the show, Total Financial Solutions Safer Money Hour, your family's guide to getting out of debt, managing money, and hopefully planning for your retirement. What does that mean when you're trying to kind of build your wealth and save and plan for your future? Well, a lot of it's going to come from a few different things. One of those is understanding how your retirement accounts work and what the laws are that's associated with it. Like how are you going to be forced, believe it or not, to take money from your retirement account when you reach certain ages? And of course, they don't make the rules very simple, and it's amazing to me why they don't do that. And usually it's not for your benefit. If you've ever seen the IRS code, you know, it's enough of a volume to fill the entire small library. If you looked at the Obamacare rules and how large that is and what that actually takes to build for your understanding, look, all of these things take and require experts. So I'm going to break it down for you. I hope reasonably simple. And if you're a little younger or on the younger side, then understand maybe for your parents or your grandparents, or maybe for your aunts or uncles. Today, increasingly, people are taking over the control of others in their family or their friends, helping them assist with their financial life. I'll give you a good example. We often have parents that are in the area of trying to build their wealth, but they're just not making the best financial decisions for themselves. In other words, they're starting to break down some of the rules, make mistakes, be penalized, pay fines, and that requires a whole problem that's built around making sure that you are not, if you will, missing some of these rules. So what are some of the rules that we would make a mistake with? Well, personally, it's called, in my opinion, the required minimum death trap if you don't do it correctly. So what that means is simple. You're going to have to be required to take money from your retirement account, whether you like it or not. And that required minimum distribution, that's really what it's called, RMD. The required minimum distribution is not designed for you to remember and to do it properly. It's designed for you to make a mistake. Because here's the rules. Ready? I'll keep it simple. It's the year following the year you turn 70 and a half, on or before April 1st. That's your first distribution. That same year, you have to have your second distribution by December 31st. And then after that, every year, it's December 31st. Does that even make sense? Like who would think of this? It has to be bureaucrats that want you to make a mistake. It has to be that Washington elite group, if you will, that we're hearing about, supposedly, drain the swamp, as you heard those chants. Maybe this is part of the swamp that needs to be drained, is people that think you and I are supposed to do our jobs, be good at it, be certified, pay all of the fees and the regulatory baloney that we have to pay. And then when it comes down to worrying about your own personal finances, almost be an expert in your own right. Does that even make sense? Why not just make it easy? Which is, hey, you got to start taking out money. Here's the percentage when you turn 70 years old on your birthday, right? Because everybody's going to be 70 at a different time. And who celebrates a half birthday anyway? And look, here's the biggest problem. You're going to speak to these bureaucrats and to these politicians and these, quote, experts. And when you do, they're going to have some fancy rationale that almost comes down to say, don't you worry your pretty little head. You just go back to, we are here to rule for you. So trust us. After all, you're not smart enough, are you? That's why you need us, all right? You're going to hear these people, they force you to do everything from wear a helmet to buy car insurance, to buy health insurance. You're just not smart enough to even decide whether or not your kid should go to this school or that school, or, just it's silly when they think all of the things that government is supposed to be requiring us to do. Is it no wonder people are just kind of fed up with some of that? So what is the required minimum distribution? How are you supposed to handle it? And how do you get around it? I don't mean that in an illegal way, but how do you get around it so that you don't end up, if you don't need it, having to spend it and get stuck? When we come back, we're going to take a short break. We're going to get back into the required minimum distribution. Joining me will be Jeff Gerard, and we'll get into the details. I'm Arif Halaby on Total Financial Solutions Safer Money Hour. This is AM 1220 KHTS. All right, welcome back to the show, Total Financial Solutions Safer Money Hour, joined by Jeff Gerard. Okay, we're talking about your family's finances and, of course, the required minimum distribution. That it's required because you have deferred money in your retirement accounts and your IRAs for so many years that means you have gone on and not paid the taxes as you have earned it. Now, look, the tax laws used to be different, and I'm going to tell you here, we are not CPAs or even tax experts. You need to check with those folks. That's their job. Their job is to guide and direct you in the tax world. My job today is just to give you a bit of an overview so you can kind of understand the questions to ask and hopefully the places to research. One of the things that we focus on is this. In the planning process of your life, when you were younger and you said, oh, I'm going to put money in my retirement account. Usually it's a company 401k, or if you work for a school district, it would be called a 403b. By deferring the taxes today, that means you're not paying the taxes today on the income side, both state and federal. However, if you have other write-offs, you might be deferring a very small amount of problem, right? Because we have write-offs today, usually, under current law.
Well, and if by we you mean me, then absolutely I do. You know, you look at someone that started out buying a home, growing their family, having children. Dependents are typically the first place people look for write-offs when it comes to their tax situation. So someone like me, it would probably not make as much sense. And again, this is a case-by-case basis where you have to talk with your tax planners, your CPAs, whoever is managing that. And sometimes that means that's you. So you have to know some of these things where you say, am I deferring, like Arif said, in a very small problem, and what's the benefit to that? So you could be deferring maybe $5,000 in income. Well, that's great. You could have gotten a lot of credits on the other side, perhaps, from your dependents. So you deferring that $5,000 each and every year when you didn't really have to, in essence, you've now created a larger bucket of money in the future. Now, why is that a problem to have more money? Well, it depends on what side of the tax equation you're talking about. And that's really the conversation today, is to see, am I going to be forced to take money out of a very large bucket of dollars? Believe it or not, we've seen clients, Arif, and you can attest to this, that have too much money on the side that has not been taxed yet. And you think, well, that's a nice problem to have, except if you coach part-time, if you are still in real estate, if you are an entrepreneur and you have a business that's growing and you just don't need the money and you're forced to take it out and you have to pay taxes on that, that becomes a problem.
Yeah, think of it this way. When you're younger, you have children, usually younger children. You have a house mortgage where there's interest, and that's under current law what you're allowed to write off.
Right.
And then, of course, you might have business expenses. However, later on in life, you have reached a place where, well, you're paying mostly principal of your home mortgage, or maybe it's paid off altogether. Your children are grown, so there's no more dependents for a write-off. And you also have no business write-offs because by definition you're, quote, retired. And here's a big chunk of money that has yet to be taxed. Why is it that rich people make the rules and make the rules to benefit themselves and their friends when most other people blindly go through and just start plunking money in their company retirement plan? And then they don't remember or realize that there's a problem until later on in life. And they go, gosh darn it, I wish I would have known. So now you know. If you're listening to this today, you can never say you didn't know.
That's right.
I'm not saying you're going to learn every little nook and cranny of technique. That's not what we're here for. We're here to get you to take a look at your own personal plan. Certainly come in and talk to us. If we can help you maybe put some of your money safe and make a decision if it's right for you, we can give you that information. That's what Total Financial Solutions is all about. But when it comes to you planning the right move, it's a triangle. It's you, your financial advisor, and your tax preparer. And all three should be either on a conference call or in the same room together and build up an idea that says, here's what we're trying to achieve. We're trying to achieve as little tax as we know. And if today we know what the tax structure is for you, then you and your accountant would sit down and say, here's the known. The known is it's going to cost you X, 14%. Are we willing to risk later on in the future it being a lot more than 14%? I don't know. But consider building a plan that allows you to have some of your money in a place where you might have already paid taxes on it, called a Roth, R-O-T-H, a Roth IRA. Now, if your company retirement plan is giving you a match, then by all means, take it. That's a lot. That's a 50%. You would have to be paying 50% in taxes off to the side just to get that same 50% back in your account. So in other words, put money into your retirement account, go to the match. So if they match 50% of 6% of your salary, that means if you earn $100,000 a year and you put in $6,000, your company puts in $5,000. Sorry,
3,000.
3,000, 50%. 6,000 and 3,000. That means you have a total of $9,000 in your account, and it cost you 6,000. That's a great deal. I would do that all day long. But remember, any dollars after that, consider a Roth, R-O-T-H, Roth IRA, because it means that you've already paid taxes on the money, but later on when you take it out, you never pay taxes today under current law ever again. So just realize that that's part of the building structure for you and your family, is to build a place to set aside money and to not be, I don't know what the right word is, but to not be taken and guided by just, the herd mentality.
That's a great point. And I think what we do is we just get locked into whatever our coworker did. I relate back to the days when I first saw a 401k enrollment application. I was working for the airport, and I thought, wow, a 401k, this is great. And they're going to give us free money? Well, this is fantastic. Well, that was just the beginning of the conversation. They give you all these choices, all these places where you can invest your money inside the plan. You go, gosh, I don't know anything. So we're like little school kids looking over each other's shoulder at each other's work saying, oh, what did you pick? I don't know. What did you pick? I don't know. I checked all the boxes. I only checked 4. So that was kind of an interesting thing there. But what I didn't get was the free money part. And so many of us in that room that were signing up for those retirement plans did not max out, as Arif was saying in his example, that percentage that your employer is going to give you. That's the incentive to you putting the money in, or for them to give it to you, is you have to put the money in. So very important you remember that part. If you're going to do anything, at least get that match and make sure that you're doing it each and every year. They also have something, and I know we're straying a little bit off the 70.5 topic here, but really the idea is to make sure that every year you're putting a little bit more in. Sometimes they even have what's called a 1% automatic increase. So if you started out deferring 3%, next year your plan would be deferring 4% of your pay, and so on and so forth, until you reach, I think, about 10% in a lot of plans. But these are the types of things that exist inside of plans. Sometimes, not in every one of them, depends on who's providing it, depends on the company that's offering that retirement plan. But you want to check with your human resources, check with your employer and say, what options do I have? Because they're not all the same. You could have that automatic increase. You could have a percentage of pay that they're matching. There could even be that Roth, R-O-T-H component, which is after tax. And it's not just a 401k thing, which is really nice. If you're a school teacher or you work for a hospital or a research facility, you might have a 403b with a Roth component. If you have a 457 or deferred compensation, you might also have that Roth component. So ask those questions. And if you do a healthy mix where you maybe put some pre-tax up to the match and then anything above that, and after that is the Roth, the post-tax side, I think you're going to have a healthy mix there. But always check with your CPA on that.
Because you're going to be looking at building in not just a diversification when you retire of where you're getting your money from. You want to have some safety. You want to have some money that, who cares if the market is up or down or China this or Brexit that. You want to have some money that's in a safe place, protecting your family's prime source of revenue someday. That is the key component, in my opinion, to any safe retirement strategy, and that is to have some of your money in a safe place. Part of that strategy requires somebody like Total Financial. We sit down, we look at it, we work with your CPA or your financial advisor. Our job is the specialist. Look, it's no different, Jeff, than if you go to a family physician. Would your family physician badmouth the brain surgeon?
No.
The podiatrist?
No.
The kidney specialist?
No.
They shouldn't. So you shouldn't work with a financial advisor who badmouths somebody who is a safety or security, if you will, a safety professional whose job it is to keep some of your money safe. Let them be an expert in their world. Let us be the expert in our world. We don't badmouth them. They might be good people. They might not be good people. It's up to them how they're going to act. Our job is to keep some of your money safe and protected. Follow me on this when we come back. What do you do if you or your mom or your dad or your family has reached age 70 and a half? They still have a job, or they're in their late 60s, early 70s, 70, 71. They're just starting to get to that required minimum distribution level. And what do they have to think about? When we come back, we'll give you that and a whole lot more when you are listening, because you are listening to me. That's Arif Halaby. And that is Jeff Gerard on your place for news, talk, and information, AM 1220. KHTS.